Well, in this morning's U.S. Bank Economic 360, the bull market of the last several years has pushed the market to its highest level in history. But while that was happening, another number was moving in the opposite direction. The actual number of stocks has been falling. U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman and Business Courier Editor Rob Dahlmeyer look to answer the question, where have all the stocks gone? Mike and Rob?
Peg, thanks very much. Mike, thanks for being here.
Good morning.
So let's get right into it. Are there fewer stocks?
Yeah, there are.
All right.
Sounds strange to say, but there are in fact fewer companies trading on U.S. exchanges these days. I mean, it's something that the average investor, it's kind of invisible to. If you're watching CNBC or reading the Wall Street Journal, you don't get a sense of this. But literally, there are in fact fewer stocks trading now. It's been declining generally, over the last several decades. This gradual decline. So right now there's about 4,000 stocks that trade on U.S. exchanges, which is not a small number. If you're looking to invest in a stock, 4,000 is a lot, plenty to choose from. But put that in context, 20 years ago there were 8,000 stocks trading. So that's a pretty sharp decline, half in fact.
Big time. I mean, and Steve Watkins at the Courier did a cover story just a little while ago about the fact that Cincinnati hasn't really seen any new public companies, any new IPOs for a long time. And the big companies that you would think might just aren't doing it.
Exactly. Yeah, so there's two dynamics at play there. One is there are companies disappearing. Yeah. The other is there are not new companies coming in to replace them. So on the disappearing side, a big component of that was the dot-com burst. That 8,000 came at the peak of that. So when the bubble did burst, naturally a lot of companies disappeared. But then more recently, we've seen just this wave of mergers and acquisitions. So companies being taken out. If you merge with a competitor, there's one less stock. Private equity plays a part here. If you buy up all the stock of a publicly traded company, one less stock. So this wave we've seen the last few years, you multiply that many times over, there are companies disappearing. And then on the IPO side, there are a lot of hurdles now to becoming a publicly traded company. There's increased regulation, costs, oversight. A lot of private businesses look at this and say, you know what, we're better off staying private. So if you have more companies being taken out by merger than are being created by IPO, that pool is going to shrink.
Yeah, and we've seen a couple in Cincinnati just this year with Frisch's and Omnicare.
Exactly.
So you did say that there's still a lot of stocks, and as obviously as we see the ticker fly by on the TV screen, but what does this do to the market?
Sure. Well, tough to say, but there is a theory, not proven, but it has some logic behind it, that this has contributed some to the bull market. The idea here being supply and demand. On the demand side, there are a lot of entities chasing after stocks. Mutual funds, endowments, pensions, 401ks, all wanting to be investing in stocks. Yeah. But on the supply side, we're seeing a dwindling number out there. So increased demand, decreased supply, that price goes up, right? No. Well, maybe.
It's a theory. It's a very interesting one, and it has to. We have half as many stocks, and again, you mentioned the bubble, but still, that's an incredible drop, really, in just a short amount of time.
It is. It hasn't caused the bull market, but it hasn't hurt either.
Right. Thank you very much. This is very interesting stuff.